1 year basis, India is still amongst the better performing markets. Uh, of late, European markets have also started to do well from a very low base, but amongst the emerging markets or amongst the peer group, India is still doing well. So it is not that only Indian markets have corrected. Now, everybody is talking about simple thing that Indian markets have corrected because of issues with Trump, and Trump's policy and tariff is something that has led to the issues, plus INR depreciation and FI selling. Let's go one by one to each one of them.
Hello, my name is Vikas Agrawal and I am the founder of AIF and PMS Experts India. What we have observed is that there are more than 90% of the viewers in our YouTube channel who have watched our video and have been watching our video continuously at the regular intervals but have not yet subscribed to our channel. So my submission to all of you is that please subscribe to our channel so that we can reach out to more individuals like you and spread the awareness about the whole investing game. Thank you so much.
Hi everyone, thanks for taking your time out from your busy schedule and joining us on our webinar. We at AIF PMS Experts India, we are thrilled to introduce our brand new show, which is Ask the Expert Show. Through webinars, we aim to share insights into diverse asset classes, forecasting knowledge amongst our investor community. So my name is Devanshu Bindlish and I am the Vice President of AIF PMS Experts India. With me, I have a speaker, Mr. Aman Chowhan, Fund Manager of Abakkus Private Limited. Let me take a moment and introduce Mr. Aman Chowhan. Aman heads the investment team in Abakkus. He has 22 years of Indian equity experience, of which for 13 years he has worked with Mr. Sunil Singhania at Reliance Nippon Asset Management at various roles. Previously, he was portfolio manager for all local and offshore scheme for PMS division of Reliance Nippon Life Asset Management. During 2006 to 2013, he was based at Singapore office of Reliance, which helped him to gain regional and global perspective for investing in India. He has a strong track record across long only, absolute, and long short strategies across the market cycle. Before joining Reliance in 2004, he was part of research team at TAIB Securities, Tata TD Warehouse, and other brokerage firms. Aman holds an MBA degree in finance from Mumbai University. Welcome, Amanji. How are you?
All well, Devan. Good to be here. Tell me.
Yeah. So thank you, Amanji, for giving your valuable time for our investor community, and thanks for joining this call. So the agenda of today's webinar is to understand market outlook from Amanji and their team, that what they think about. Over to you, Amanji.
Is my screen visible to everyone?
Yeah.
Fine. So let's start directly with markets, and I'll try to be as open and as practical as possible. It's volatile times that we're facing right now, especially the last 2 months, January and February, have been quite brutal. What you see on the screen is data as of mid of Feb, where you can see that in the last 3 months, the mid and small cap index has corrected 10%. So individual stocks would have corrected anywhere between 20 to 30%. And Nifty is down 3-4%. This is as of mid Feb. After this, market has further corrected in near term. Now, in this backdrop, 2-3 things come out. One is that it's not just India. It's been a global volatility which has happened. If you see the regional markets also, they are also all corrected over the last 1, 2, 3 months kind of a scenario, right? Overall, on a 1 year basis, India is still amongst the better performing markets. Of late, European markets have also started to do well from a very low base, but amongst the emerging markets or amongst the peer group, India is still doing well. So it is not that only Indian markets have corrected. Now, everybody is talking about simple thing that Indian markets have corrected because of issues with Trump, and Trump's policy and tariff is something that has led to the issues, plus INR depreciation and FI selling. Let's go one by one to each one of them. First thing is Trump. We feel that Trump is not the reason for the current market volatility. Trump is just the trigger, but he is not the reason. The reason for the correction or the volatility in the market is that there has been slowdown in India. 1 year back, even 7, 8 months back, if I spoke to any of the corporate that we have invested or whomever we spoke to, everybody said this thing that in India, current year second half is going to be much better than the first half. Second half may pick up hoga. That is what everybody mentioned. Because we were slowing down, 7, 8% growth was there, and that was coming down to 6, 7%. And they said, no, growth will pick up in the second half because monsoon has been good. This year, Diwali's festive season is going to be good for versus the earlier year, and we are getting into a large marriage season. There's a bunch of a marriage over the next 2 to 3 months, and hence spending and consumption is going to pick up, and things will be much better. Unfortunately, that has not happened. Second quarter, we all know we reported 5.4% GDP number, which was a 7 quarter low. Numbers so far also have been similar. Whatever monthly numbers that we get, which is like auto sales, cement sales, GST numbers, all those numbers are in say mid single digits, same 4, 5, 6% kind of a thing. So that expected pickup in India did not happen, and markets were trading at a decent premium. This is what you see on the screen. Markets were at a high few months back. So people were waiting that if market's correct, I'll sell. Otherwise, I don't want to sell because market is rising. Let's continue with the party. Party is on, so not a worry. But the economy was slowing down. And in this backdrop, Trump coming in came in the trigger. You always need some trigger to do some for a change course or a correction or a change of direction. Right? So that trigger was the Trump. Trump came and he announced that he's going to put tariffs. Now people knew, the market were aware that he's going to put tariffs. That was not a surprise. The surprise was that he said I'll put a 25% tariff and a blanket tariff. At the same time, he announced that 25% tariff. The very next day, he said that I'm going to defer this tariff and we'll see what to do. And people realize that he is making a big bang announcement, but using that, he wants to negotiate. It's not that he's going to put those tariffs. But at the same time, the market expectation was reset. What was expected to be a 5-10% tariff suddenly came to a 20-25% tariff, and markets had to adjust. Now, what happens to this scenario is that if Trump goes ahead and puts a blanket, say 20% tariff, this means that US is a net importer, right? So 70-80% of what US consumes is being net imported into US. If there is a tariff which comes in, say 20% tariff, then everything that gets imported into US becomes expensive because you need to pay a tariff duty. So for example, earlier if you're buying something for 100 rupees or $100, that becomes $120, which means that there's going to be a high double digit inflation because you're buying things expensive, and no consumer anywhere in this world likes that you need to pay higher for whatever you want to consume. So to counter this, it was obvious that the Trump would try and appreciate the dollar, because if the dollar appreciates, then your import bill impact is negated by that sense. So earlier, if your dollar was valued at $100, if it goes to 110, then your import bill, which is 120, gets negated, right? So you have a 20% tariff, but a 10% dollar appreciation. So your net impact is in single digit, right? So the dollar started to appreciate. When the dollar started to appreciate, global money moved towards dollar assets, because if dollar appreciates, other currencies will depreciate. That's the way things work, right? So the 84-85 rupees INR currency, which today is 87-88, which has happened in the last 3 months, that has happened predominantly because dollar has appreciated. It has not happened because INR has depreciated. There's nothing wrong in India for the INR to depreciate. It is more to do with the dollar appreciation. In fact, if I have to show you the chart here, INR depreciation is exactly similar to what the Chinese currency depreciation is. For the other emerging markets, they have depreciated in double digits. Right? So INR is still among the better performing currency. But Trump was the trigger, and this is the main issue. That slowdown in India or the expected pickup or acceleration has not happened. And because of that, the premium valuations of Indian markets could not sustain, and markets become volatile. And it's a global volatility. It is not something that to do specifically with India. Only this slowdown is specific to India. Otherwise, it's a global volatility. Now, obviously, FIs have also made money, so they have been booking profits. They're also moving some money towards the dollar. But what we see in the media that FIs are sold X or FIs sold Y, last 6 months they have been non-stop selling, and last 12 months they are net sellers, is all true. But it's only one side of the picture. The other side of the picture is whatever FIs are sold, an equivalent amount of money they have invested back into the IPO market. So what goes discussed is only the secondary market sale, what you sell on a daily trading basis. But what you invest via QIP or an preferential share or in the IPO, that doesn't get captured, at least in the media. So if you look at the number here for calendar year 24, 15,000 is the number of secondary market sales, but 14,400 is what the primary market purchases, which is also a record high. It is the highest ever in the history of the amount, because every week there was some good IPO that was coming in and everybody was investing into that, right? So net FIs are not sold anything significant, and what they have sold is not even 2% of the overall holding. So it is not that FIs are running away or they are selling, and because of it the market is falling. Yes, they are selling. Earlier, what used to happen was they used to be investing both in the IPO as well as in the secondary market. In the last 12 months, they have invested only in the IPO market. In the secondary market, they have sold. So earlier, you got 100 rupees from IPO and 100 rupees from secondary market. This year, what has happened is you have got 200 rupees in IPO, but 200 rupees sale has happened in the second market, and the net inflow is zero, which earlier used to be 100 to 150. So in that way, yes, inflow has reduced or has become zero, but it is not that we have seen a big outflow and the FIs are selling, and that's the reason the market is volatile. Market is volatile because expected pickup in India has not happened, and it is also volatile because of the Trump issues, and it's a global volatility. If you see, all regional markets have seen volatility, and the outflow that we are discussing has also happened across markets. If you see Brazil, Indonesia, Malaysia, Philippines, Korea, Taiwan, Thailand, everybody has seen FIs. This number here, everybody has seen FI outflow. So it's not specific just to India per se. Now this is the backdrop. Because of this, we have seen the volatility, and because of this volatility, obviously valuations have come back. Market stocks have corrected 20-30%. So from that perspective, valuations have come back, and now we are back to 18-19 times 1 year forward earnings for Nifty, which has been the 10-year average. If you take the average from 14 to 24, then the average Nifty valuation 1 year forward valuation has been 19, and we are almost close to there. But if you see the ROE is still better. Price to book also, we have now come back to almost the 10-year average. So the market should stabilize at current level is what we've seen, because we are closer to the average here. It can marginally go down. Yes, it can, but I don't see a 20-30% correction from current levels either, right? Yes, every day mid and small caps would be seeing some drawdown, but it is not something that is going to be applicable overall to the market unless globally something goes wrong. Right now, specific to India, we think things are now stabilizing. We are back to the fair market zone. Is market cheap now? No, it is not cheap. Don't get it wrong. It is not cheap, but it was expensive earlier. Now it is come to the fair market. And from a fair market, one should be expecting a fair return, not an abnormal return. Last 3-4 years, people have made abnormal return. You have made 30-35% CAGR kind of a return, which is on the higher side, right? So don't expect a similar kind of return from the markets. Expect a fair return, which is a mid-teen kind of a return from these levels, is what we think over a 3 to 5 year period. I'll not say 10 years, but I'll not say 1 year also. Somewhere between 3 to 5 years is a decent holding horizon for equity investors. And from that perspective, a mid-teen kind of a return is still possible from Indian markets. Now, why is this possible? Let's first look at these. See, these are the valuations that you see. You see most of the sectors where the valuation has gone beyond the 10-year average have come back. There has been a mean revision and sectors have started to come back, right? So that valuation comfort is setting in. What is going to trigger the upside in the market is as follows. Now, what is the issue that India is facing? That is that demand is not picked up. What has the government done for this? Government has already announced the tax breaks in the budget, which we all know about. They have also announced liquidity measures by the RBI, and there's already a 25 bips rate cut that has happened. Also, what has happened is last year there were elections for good 4 5 months. There was no large government ordering as well as tendering because of the code of conduct for election. And we all know some of the financial resources of the government would have gone in conducting the elections and spending for the election. Now that election is behind us, that money started to come back. So the government tendering activity as well as capex activity and spending activity has started to come back. Bills which were pending with the government for the last 2 3 6 months for the work done and which are not getting cleared are now started to getting cleared. The finance minister said this in the budget, and at the ground level also we are seeing. Monsoon last year has been good. The benefits of that plus the MSP price is also started to be visible. We are seeing some amount of pickup already happening in the rural markets. So now government has already acted to address the slowdown, right? The benefits of which will be visible in the next 3 to 6 months. Immediately overnight, you can't see the benefits, but it is not a hope that government will act. Typically, what happens is you see a problem, you see a slowdown or something else, you say, oh, the government should act upon this, they should do something, Modi should act upon this, Modi XYZ. Here, the action has already happened. So it's not a hope that the government will do something. Consumption was slowing down. Government has acted by the tax breaks. Capex was slowing down because of the elections. That is now reversing. Liquidity was tight. Government has said that they maintain the fiscal deficit here, which has allowed the RBI to go ahead and do a rate cut. The government has committed that yes, the fiscal deficit will come down every year, and they're maintaining that. And immediately after seeing this, the RBI had that first rate cut which happened. And in the next 3 to 6 months, I'm expecting another at least another 25 bits of another rate cut to happen in India. And the benefits of that will obviously be visible, right? So this is what the backdrop is that government has acted, and hence we are confident that the outlook for Indian equities is positive. It's not that one should be too fearful, kind of thing. Now, what are the other dynamics in India? You see the inflation. Inflation, which was pretty high, has now cooled off. It is uh, at the comfort zone, around 4 to 5% of what the RBI comfort zone is. The first rate cut has happened. We expect another rate cut to come in the next 6 months. In US also, inflation is now stable and the rate cut could happen, but this is something which is still not very clear because every week, every day, there is some new announcement which is coming from the Trump administration, and we also not very clear as to what they are planning to do ultimately. Hence, this is still uncertain. Because of this uncertainty, I am expecting the markets to stay volatile in the near term. It can go 5% up and down from these levels. There is no tearing hurry to buy or to invest, because what investors today are asking is that we will invest once we see demand picking up. We'll invest once we see that growth is coming back to India, which is going to take some time because the measures have just got announced. The budget just happened in this current month, and the benefits of rate cut also has just happened, right? So in the next 3 6 months, we'll see the benefit, and this is when the investor interest in India will also come back. And that is broadly what the market outlook for us is, that overall we expect things to stabilize at current levels, and once the economy starts to pick up, things will start to move up. Not everything is negative in India. If you look around, GST numbers have started to pick up. Digital transformation which is happening in India is there. Last few days we have seen sharp rise in the temperature also, which means that it's going to be a severe monsoon very likely this year, which means that demand for ACs and refrigerators and everything is also going to be pretty robust. So that spending is going to happen. Marriage season is going pretty decent, and government capex and everything is also picking up. So it's not that everything is slowing in India. It is, there is no negative growth in India anywhere. It is just that the demand did not accelerate. That 4 5% growth rate did not go to 7 8 9%, for which everybody is hoping for, and that is where the disconnect was, and that's where this situation is. So keeping this into mind, because of the global volatility, we expect near term this current volatility to continue, but we are almost closer to the 10-year average valuations, right? There is no reason for the markets to go significantly lower than the 10-year average, because all the positives which were there in India, say 2 years back, 3 years back, which is a strong government, proactive Modi, the demographics, the under penetration, China plus one export opportunity, manufacturing picking up, Atmanirbhar Bharat, PLI scheme, everything is there. There is no change in that. And on top of that, we now have the tax breaks also which have come in, right? So all that scenario is still the same. It is just that the growth did not pick up because of high inflation. The bottom of the pyramid of the middle class in India consume less. Now, once this come back, growth will also come back to India. And if not, then we expect more action from the government because it is very clear that the government is pro growth. They want good activity or good growth in India. So this is what the backdrop is. Just because global there is uncertainty, near-term markets can still be volatile. Now, globally also, what is the issue? The issue is that today we are only discussing what the Trump is saying, which is I'll put tariff here, I'll put tariffs there. We have yet to see how the other countries will retaliate. It cannot happen that tomorrow you decide that I'll put a 20% duty on China and China will do nothing. Or if I put a 25% duty on Canada and Canada will do nothing. They'll also retaliate. They can put a counter duty, they can put a counter tariff, they can devalue the currency, they might put some certain restrictions. We don't know. So the market is not yet prepared for that. And this is where it is causing this volatility because this is something which is uncertain. Now we know for sure that what the Trump is going to do broadly, but we still don't know what the response is going to be. And based on that response, how things will set up. And in this near-term uncertainty, things are becoming like a standstill. The reason US market also is correcting in the last few days is because economic activity in US are also stopped. Earlier, you thought there's going to be 10% duty because you imported too many things. Now you expect to know the duty can be much higher, and hence the seller has stopped to sell. People have stopped to consume because they don't know tomorrow whether they want to. They'll end up spending much more for their daily needs or what's going to happen. Companies have stopped their capex plans or expansion plans, waiting for clarity. So when there's uncertainty, we stop doing our activity. We take a backseat and we wait for clarity to happen. That is what is happening in US. Right now, there's uncertainty, and hence economic activity in US is also stalled. Not stalled, but it is also slowed down, and that is the reason the US equity market is also correcting a bit because they also don't know as to what needs to be done. But I expect these things to get settled in the next 3-6 months. Whatever that Trump has to do, he'll do in the next 1-2 months. Whatever retaliation has to happen will happen in the same time. And over this period, there could be a positive outcome from the Russia-Ukraine crisis also, because as we speak, they have started to negotiate and they have started to look towards settling that issue. Israel issue is also settling on its own. So that political uncertainty, the geopolitical risk is also dwindling, and clarity will remain in the next 3 to 6 months is what I feel. By that time, economic activity in India would have also picked up because for whatever reasons I've already discussed, and market will start to look back. So this is what our advice to most of our clients has been, that if you're looking to deploy capital to the markets, we can't time the market, we can't time the bottom of the market. Start investing, but stagger your investment over the next 3 to 6 months. It's not 12 months stagger or 24 months stagger, but don't put everything upfront because next few months could be volatile. Someday we may feel, oh, the stock is created 20%, 30%, or kitna girega, right? You don't know. You'll buy something and then it can turn another 5-10%, right? So don't get into that mode, that trying to time the market kind of thing. If somebody has a faith that whatever Modi has delivered, he'll continue to do that. And there is demand potential, growth potential in India for whatever positive that is going on, then it's going to happen. This is a near-term blip. See, nothing in this life or in this world is linear. Things don't move in a straight line, right? So we were doing well. Now that straight line is slightly wobbly. We'll stabilize, we'll take some breather, we'll reset ourselves, and again that movement will come up. And that is what one has to believe in. And it's not just hope, because we have already seen the government action towards it. So what I'm telling you, ho jayega or hoga aisa nahi, government has acted. Now the outcome of that is not yet coming. It will come because action is already there. If it doesn't come for whatever reason, government is prepared to take one more step ahead and ensure that things do pick up. So that's what the broad thing is. It's the global volatility which is creating the near-term volatility that we see. From the currency view also, we are closer to 87, 88 levels. From here on, if INR has to go to 90 odd levels, it's possible, but it will happen only if the dollar appreciates. If the dollar doesn't appreciate on these levels, INR is not going to depreciate on its own. If there's competitive devaluation globally, say China, Canada, Mexico, whichever countries are seeing tariffs, they devalue the currency, then India also has to devalue to be relatively competitive. You cannot have that other countries' currency is devalued and Indian INR doesn't get devalued. So that is possible, but it will happen only if there's a global reset, not on its own, right? So the currency is stable because we have decent forex reserves and we have a decent trade balance. Earlier, oil import used to be the biggest import bill, and hence we already had a trade deficit. But the way IT sector and the pharma sector has been grown, and we are almost getting $30 billion of NRI remittance every year from global NRI. Our current account deficit is already reduced, and our non-current account deficit is also reduced significantly. In a year's time, IT export revenue is going to be equivalent of the oil import bill that we have, and hence the trade imbalance that we have is not going to be there. And our oil import bill is also not growing to the extent of what the growth is because of the ethanol blending. Already we have achieved 15% ethanol blending in petrol, which is headed towards 20%, and plus 80% of the incremental capex of the spending is happening now on renewables. So we are setting up solar plants, we are setting up wind energy, and that is helping in reducing the dependence on oil, right? So from that perspective, INR is better placed. It is already among the better performing currencies, and that I expect should stay. So from an equity market perspective, markets ultimately is a slave of earnings. We have been saying this, we have been experiencing this. Once growth picks up, once earnings growth picks up, market will also start to move up, which should happen in the next 3 to 6 months. So this is broadly what the market outlook is. I think I explained it to you as to what led to this global uncertainty, what led to the correction in the market, the action that the government has already taken, and the outlook going ahead. I'll take a pause now. Devanshu, how do you want to do? You want to open up for Q&A and we can discuss?
Yeah.
We can. Oh, happy to do
First
that.
of all, thanks for giving insights about market outlook. It was, very good market outlook. We got a lot of insights about markets. What do you think as a house and your personal view as well? Coming back to the question, so my investor community has a couple of questions. So they are asking me that which sector you look lucrative for 2025, and what do you think growth stocks would appreciate more or value? So this is the question from our investor community. Over to you, sir.
It's a very good question because if you see the market history, every 2 to 3 years there is sector rotation in the market. Sectors that have done well in the recent time, after 1 to 2 years, some other sector emerges. 25 years back in the Y2K phase, there was IT companies that were doing well, TMT companies were doing well. Then there was a phase when pharma companies did well. There was a phase when coal companies, utility companies, power companies did well before the coal scam broke out in India. Few years back, IPO market was doing very well. Last year and a half, PSUs, defense, and railway stocks are doing well. Prior to that, when other sectors that were doing well. So every 2-3 years, the sector rotation happens. So now it's very clear that the last favorites, which was PSUs and defense and railways, they are not going to be the new favorites again. They might recover from where they are, but it's not going to be. So which sector is going to take the lead? I think overall, financial sector should now take a lead because last 2-3 years they have been market performers. The NPA cycle in India is still under control. RBI has been very proactively handling the situation there, and valuations they are still reasonable. So the mid-sized banks, NBFCs, they are all trading in 1.5 time book kind of a scenario, which is a fair valuation, which is a decent valuation, and hence the financial sector can do well. Plus rate cuts are going to happen. So we have already seen one rate cut, another rate cut is due in the next 3-6 months. So financials overall is looking good. Chemical sector to us is now looking good. Last 2 years have been pretty challenging for the chemical sector because of price cuts due to Chinese dumping or resumption of Chinese supplies post opening up the COVID lockdown. uh, that seems to be bottoming out. It is not yet bottomed out, but it's almost at the verge of bottoming out. In the next few months and the next 1 2 quarters, that sector will bottom out, and that 30 40 p of chemical sector has now come down to 10 15 p, and this stock is also looking good. The third segment that is looking good to us is the EPC segment, which is the construction sector, both civil, urban, or infra construction companies, because in the next few months we are going to see good amount of government tendering which is going to happen, which is going to increase the order book of all these companies, right? So the government spending is going to come back, and that is something which is going to be a bit beneficial. And now, post the recent corrections, many of these companies are trading at 10 12 p 1 year forward earnings, which is a very attractive valuation for these companies. Among the consumption space, we prefer more of consumer discretionary than consumer staples. See, because of the tax breaks, you have higher disposable income in your hand, but because of that, you're not going to eat double, right? You're not going to consume uh, 2x or more than what you're currently eating. But you can use that money maybe to buy a two-wheeler, maybe to book a car, to buy that AC or whatever is in your mind, right? That consumer discretionary is going to see a demand pickup than consumer staples, and then hence we prefer consumer discretionary or consumer staples from a sector perspective. Metal is going to be volatile because it's a global commodity, it's a global pricing, and how Trump and China react is going to determine metal. Hence, in the near term, metals can be market performers. IT, especially mid cap IT, is looking good because the large cap IT is not corrected much. Infi, TCS, HCLTech, Coforge of this world, they have not corrected much, but the mid-size IT companies, they have corrected 20 30%, and they're going to be the beneficiary of the INR depreciation. So earlier what they were realizing of 84 85 is now going to be 87 88. So that 4 5% growth anyway is going to come because of currency depreciation, plus there's going to be margin improvement also. And now with the post the correction, the stocks are also attractive price. So mid cap IT, and for the same reason mid cap pharma is also looking good. So these are the 3 4, you can say, sectoral preferences that we have in the current scenario.
Thanks for giving this brief. So before we wrap up this call, what do you think? As you know, Abacus has multiple PMSs. What do you think? What right strategy as of now for the deployment? What should one should choose? Out of your three PMSs, over to you.
So we have three strategies. One is what we call the growth fund or the all cap strategy, which is a combination of large caps and mid cap. So at any given point of time, this fund would have 40 to 60% large caps and the balance would be mid caps. The second strategy that we have is the opportunities fund, which is a dedicated mid and small cap portfolio. And the third one, which is a new strategy, year and a half old strategy, which is the AIF strategy or diversified alpha strategy, where we invest across the 4 segments of the market, which is large, mid, small, and micro, all 4 of them. Now, it's the same team, Sunil and me, who are handling all these 3 strategies. It's the same philosophy and style that we follow. So for us, all 3 are in a way same. It is up to the client to decide or the investor to decide as to which one is suiting him more. What suits me more might not be suiting him more, right? If somebody is okay to bear the near-term volatility and it's a 3 to 5 year horizon, then the mid and small cap makes sense, because obviously from a lower base or a smaller base, these companies can go faster, and hence we have a faster earnings growth in this segment. That is something that is obvious. But somebody wants a decent balance, not just only mid caps, but some stability of large cap also, then all cap is the right strategy. Somebody looking at equity markets for the first time or has a very low equity exposure, right? And is worried for the global reasons, which is rightly so. Then for those people, the ADF strategy is suitable, because here you get the flavor of the full market. So you have large cap also, mid cap also, and small caps also. So at any given point of time, something or other will always be performing in the market, something won't be performing. But hence it's a pretty, you can say, diversified exposure in that sense. So new investors or early equity investors, ADF is the right thing. Somebody who can handle the volatility, then mid and small cap is the right strategy. Normally, people do ask us, mid caps are more volatile, they are more risky. We have a slightly different view. For us, it's not necessary that mid caps are more risky. Because ultimately, what is risk? Risk is doing something that you don't understand. So tomorrow, If you go ahead and buy an Infosys or a Reliance without understanding what the company is up to and what is the global scenario, what is the margin outlook, what is the business outlook, you're taking an equally big investment risk. But if you get into a mid cap, being fully aware as to what you're getting into, what your risk reward equation is, that you're not necessarily taking a higher investment risk. Yeah, but definitely you're taking a higher volatility risk and higher liquidity risk, because these are smaller companies of a smaller market cap, and hence there can be near-term sharper price impacts based on both buying and selling and based on the sentiment change that happens in the market. If somebody is okay with this volatility, you can say a characteristic of a mid and small cap, then the return potential in this segment is the maximum, and that's obvious. Somebody wants to strike a good balance, then the growth fund or the ALCAP strategy is the best, because that's a good combination of large cap and mid caps. So this is the way we have the three strategies, and this is the positioning of the three strategies. And depending on how the client is comfortable with deploying his capital, he should be choosing the strategy. This is what I would suggest. And as I've already mentioned, don't come in lump sum. Suggest come over the next 3 to 6 months. Don't make it 12-month or the 24-month SIP kind of thing. If you have an SIP, continue that. That's a separate thing. But if you want to deploy capital, do it over the next 3-4 months. Stagger it and do it so that whatever global as well as local volatility comes in because of the uncertainty that is there right now, you'll be able to maximize and capitalize on that. It is only when you invest in a down market is when you can make money in the bull market. So that is a simple theory, but that's a very practical, logical theory, and that should be applied in the current juncture also.
Thank you, Amanji, for giving a lot of insights to us today. And thanks for giving your valuable time as well. Hi, everyone. Thanks for giving your valuable time as well and joining over this call and this webinar. Thank you, everyone. So if you have any queries, you can reach out to us at www.aifpms.com, or either you can call me directly at 8368586435, or either you can write down an email to me, which is devanshu@aifpms.com. Thank you, everyone. Have a lovely day ahead. Take care. Bye.
Thanks, everyone.